Hello, my name is Oscar DeHello, and I'm going to be doing problem 15a found in page 679, the common size financial statements. We'll be referring back to the previous problem found in 678 under Linux Company balance sheet and the income statement right here. For number 1, it states, present the balance sheet in common size format. The common size format formula is any number over total assets. The total assets for the Linux Company in the balance sheet is 17,100,000. That would always be the denominator, while any number, say for example cash, of 960,000, it will be in the numerator. It will give you a decimal, and you would have to present that as a percentage. So you'd move the decimal place 2 to the right, twice to the right, and we'll just round to the first decimal place. And I'll just give you an example. 960,000 divided by the total assets of 17,100,000. So you have to move it to the right, the decimal to the right, in between 5 and 6, and it will be 5.6% for this year. Last year they made 1,260,000 in cash, and I drew the line so I can divide the two, because you would have to use the total assets for that year, which is 14,880,000. So 1260 divided by 14,880, giving you 8.5%. And here it is right here. 5.6 and 8.5 for cash. For marketing security, this year they made a 0% decrease nor increase. I'm sorry, scratch that. Just 0%. Last year they made 2%, so which is a 2% decrease. So with this vertical analysis, it focuses on the relations among the financial statement items at a given point in time. So what we're doing is using last year and this year. And you can see right here, you can see a 2% decrease. You can see also a 3% decrease in cash. Going down the list, sorry. The account receivable is 15.8. Last year they made 12.1%, which is a 3% increase, roughly. Actually, almost a 4% increase. Okay, and the inventory is 22.8. Last year is 16.1. Prepaid expense is 1.4. Last year's 1.2. If you add all those up, the current assets, it should equal the total current assets, and 45.6 for this year, 39.9 for last year. You should double check your answers. And right here, the total current assets of 7,800,000, divide that by 17,100,000. should equal 45.6. For last year, 5,940,000 divided by 14,880,000 would equal 39.9%, as shown below. Total assets should always equal 100%, and the difference between current assets and total assets will give you the plant and equipment net. Percentage will be 60.1 last year, and for this year it's 54.4. Moving down the list of liabilities and stockholder equity, the current liabilities for this year is 22.8. For note payables, it'll be 21.1. Together, it'll be 43.9 for total liabilities. Last year, made 18.5 for current liabilities. Note payable is 20.2. Together, total liabilities equal 38.7. Make sure you double check your answers. It'll be 7,500,000 divided by 17,100,000 for this year. Last year is 5,760,000 divided by 14,880,000. For stockholder equity, the preferred stock should equal 10.5, common stock 35.1, return earnings 10.5. Together, the total stockholder equity should equal 56.1. Last year it will be 12.1 for the preferred stock. Common stock is 40.3 and return earnings is 8.9. Added together it should be 61.3, and don't forget to check your answers. The stockholder equity and total liabilities should equal out to be 100%, just like the total assets. Moving down to number 2. Present the income statement in common size format. It's basically the same formula, but it's any number over sales. Sales is 15,750,000 for this year and 12,480,000 for last year for sales. And to find the net income, you would have to subtract the COGS, which will give you the gross margin. Subtract the expenses of sales and administrative, would give you the net operating income. Subtract the interest expense. So it looks something like this. Give me 1 second. Yeah, should have this. So you subtract the cost of goods sold, it will give you the gross margin. Subtract the selling and administrative expense, will give you the net operating income. Subtract the interest expense, to give you the net income before taxes. Then subtract the taxes, will give you the net income. So it's a lot of subtraction here. Okay. So just like total assets, sales will be 100%. So both of these, 15 million and 12 million right here, and last year and this year, will be 100%. Going from COGS, well, starting from COGS, you would put that as a numerator over the denominator of sales. So 12,600,000 over 15,750,000 will equal 80% for this year. Subtract that, should give you the gross margin of 20%. Or you can use the formula, 3,150,000 divided by 15,750,000 will give you 20%. Then you would have to do 1,590,000 for selling and administrative expense. Divided by 15,750,000 would equal 10.1%. And going down the list, net operating income 9.9, interest expense 2.3, net income by taxes 7.6, income taxes is 2.3, leaving you off with a net income of 5.3 this year. Last year, The sales was 100%. Well, it's always 100%. COGS was 79.3. Gross margin is the difference with 20.7. The expense was 12.5, which was a decrease of approximately 2%. And the difference would be 8.2 for the net operating income. Subtract the interest expense, 2.4. Will give you the net income before taxes of 5.8. Then you will subtract the income tax, equaling off to 1.7, and it will leave you off with 4.0%. And this was number 2 in the income statement, common size format, down to the net income. A note is that managers and investments look for the gross margin percentage to measure the profitability. Like, for example, on page 650, where it talked about McDonald's versus Wendy's, is mainly used to compare the two companies. The reason why, I don't know if I said this earlier, but the reason why we use this vertical analysis is to focus on the relationships among the financial statement items at a given point in time, unlike the horizontal, where it examines changes in the financial statements over time. And that should be it. Well, thank you very much, everyone. You have a wonderful Christmas and enjoy the rest of your holiday.